Have you ever stopped to wonder why we actually use money to buy things? I mean, really think about it. Imagine trying to buy a brand new smartphone, but the only thing you have to trade for it is a giant sack of wheat. You literally walk into the electronics store, lugging this massive sack of wheat and try to strike a deal. Absolute nightmare, right? And what if the store owner doesn't even want wheat? What if he wants shoes? It sounds completely ridiculous to us today, but for a huge chunk of human history, that is exactly how people had to trade. It was a messy, super complicated system.
So, welcome to this explainer on money and credit. Today, we are going to build complete conceptual mastery of how our economy actually ticks. We're going to look under the hood of the financial system to explore what money truly is, how banks operate, and the incredibly powerful role that credit plays in all of our lives. If you're looking to totally master this concept, you are in the exact right place.
Here's our roadmap for today's explainer. We'll start with the magic of money, then move to how modern banks work, the two faces of credit, decoding terms of credit, formal versus informal sectors, and finally, credit in India today.
All right, let's jump straight into part one, the magic of money. Before we get into complex banking, we have to understand the very first problem humans needed to solve.
So in a barter system, goods are directly exchanged without using money at all. Let's go back to our earlier example. A shoe manufacturer wants to buy wheat. To actually make this happen, he has to find a farmer who not only has wheat to sell, but also specifically wants to buy shoes. Both parties have to agree to sell and buy each other's exact commodities. This massive headache has a name. It's called the double coincidence of wants. It's an essential but honestly incredibly frustrating feature of the barter system. But introduce money into the mix, and this problem is completely eliminated. By acting as an intermediate step, money becomes the medium of exchange. The shoe manufacturer just sells his shoes for cash, and then uses that cash to buy the wheat. He doesn't have to wander around finding a farmer who happens to need a fresh pair of kicks.
Now, throughout history, Indians used all sorts of things for money: grains, cattle, and eventually metallic coins like gold, silver, and copper. But modern currency is actually really different. Unlike ancient gold coins, modern paper notes have absolutely no everyday use of their own. You can't eat a 500 rupee note, and it definitely isn't made of precious metal. So why on earth is it universally accepted as a medium of exchange? Well, because it's authorized by the government. In India, the Reserve Bank of India, or the RBI, issues these currency notes on behalf of the central government. Indian law legalizes the use of the rupee, meaning no one can legally refuse a payment made with it. And honestly, that legal authorization is the real magic here.
Okay, moving right along to part two, how modern banks work. Let's say you have some extra cash from your salary at the beginning of the month. Where does it go?
Let's kind of whiteboard this out, because understanding this mechanism is absolutely fundamental. Think of banks as the great mediators of the economy. First, you have people with surplus funds. We call them the depositors. They want their money kept safe, and they wouldn't mind earning a little interest, so they deposit their cash into the bank. Now, the bank doesn't just lock all that cash in a giant vault to sit there doing nothing. They only keep a small proportion, usually around 15% in India, as a cash reserve. This is just to pay depositors who might come in to withdraw money on any given day. So what about the rest of it? Well, banks take the major portion of those deposits and use them to extend loans to people who desperately need capital for economic activities, the borrowers. Finally, the borrowers repay these loans but with a higher interest rate than what the bank pays to the depositors. And that difference? The difference between what is charged from borrowers and what is paid to depositors? That is the bank's main source of income.
So when you put your surplus cash in a bank, it sits in an account. And because you have the provision to withdraw your money on demand whenever you want, these are called demand deposits. And here is the really brilliant part. Demand deposits share the essential features of money itself. You can use them to directly settle payments without pulling out a single physical currency note. How? Through a check. A check is basically just a piece of paper instructing the bank to pay a specific amount from your account directly to the person whose name is written on it.
Let's test this out with a real-world scenario from our textbook. Imagine M. Salim has to make a payment of 20,000 rupees to a guy named Prem. Salim writes out a check for 20,000 and hands it over to Prem. Prem then takes this check and deposits it into his own bank account. Within a couple of days, what actually happens? The bank's computers do all the heavy lifting. Salim's bank balance decreases by 20,000 and Prem's balance increases by 20,000. Boom! The transaction is complete. Money was transferred seamlessly, safely, and directly between accounts without a single physical paper note ever changing hands. It really shows just how completely integrated deposits and checks are into the modern banking system.
Next up, Section 3, the two faces of credit. Now we know what happens when you deposit money, but what happens when you are the borrower?
Credit, or taking out a loan, is basically an agreement where a lender supplies a borrower with money, goods, or services in return for the promise of future payment. But here's the thing, credit has a dual personality. It can be your absolute best friend or your absolute worst enemy. Let's look at Salim, a shoe manufacturer. He gets a massive order, needs to hire more workers and buy raw materials, so he obtains credit for working capital. He completes the order, makes a fantastic profit, and easily repays the loan. Here, credit played a vital, incredibly positive role. But contrast that with Swapna. She's a small farmer growing groundnuts. She takes a loan from a moneylender for cultivation, hoping the harvest pays it back. But then, tragedy strikes. Pests completely destroy her crop. She can't repay the moneylender, and the debt swells up with high interest. The next year, she takes another loan, but the crop is just normal, nowhere near enough to clear the old debt. Eventually, she is forced to sell a portion of her land just to pay off the loan. Credit didn't help her at all. It pushed her into a devastating situation known as a debt trap.
So, let's pause here and check our understanding. In one case, credit makes a person much better off. In another case, it completely ruins their livelihood. The crucial question is, what actually makes the difference? Well, whether credit is useful or not depends primarily on two things. First, the risks in the situation. Salim's shoe order was a low-risk, guaranteed sale. Swapna's farming relied on weather and pest control. That is a very high-risk situation. Second, it depends on whether there is some support or safety net in case of a loss. When Swapna's crop failed, she had no insurance and no support, leaving her entirely exposed to the painful reality of that debt trap.
All right, moving into Section 4, decoding terms of credit. Because loans definitely don't just happen with a friendly handshake.
Every single loan arrangement specifies an interest rate that the borrower absolutely must pay to the lender, along with the repayment of the principal amount. But that's not all. There are four main pillars we need to look at, which collectively make up what we call the terms of credit. These are, number 1, the interest rate, number 2, collateral, number 3, the documentation requirement, and number 4, the mode of repayment. Think of a scenario from our textbook, like Megha taking a housing loan of 50 lakh rupees from a bank. She has to agree to an annual interest rate, she has to provide documents showing her employment and salary, she agrees to a mode of repayment via monthly installments over 10 years, and the bank keeps the papers of a new house as security. These terms vary substantially depending on who the lender is and who the borrower is.
Let's actually zoom in on one specific pillar for a second, because it is absolutely vital for understanding economic inequality in our society, and that is collateral. Collateral is defined as an asset that the borrower owns. Now, this could be a piece of land, a building, a vehicle, livestock, or even deposits in a bank. The borrower uses this asset as a guarantee to a lender until the loan is finally repaid. Think of it as the lender's safety net. If the borrower fails to repay the loan, if they default, the lender has the legal right to sell that asset, that collateral, to recover their payment.
Now let's apply this concept to the real world and test our understanding again. Given that a large number of people in our country are poor, how does this strict demand for collateral by banks actually affect their capacity to borrow? If you think about it, it acts as a massive, almost insurmountable hurdle. Poor households, landless laborers, or small street vendors simply do not own significant assets like buildings or vehicles to offer as collateral, and often they completely lack the formal documentation showing stable employment. Because banks strictly require collateral and documents to minimize their own risk, the poor are very often entirely locked out of getting fair, low-interest bank loans.
Which brings us perfectly to Section 5, formal versus informal sectors. Because if poor households are blocked from getting bank loans, where do they go when they desperately need money? When we look at this 2019 National Statistical Office survey on where rural households in India get their credit, we see a really stark split. The formal sector, which includes commercial and cooperative banks, provides about 61% of credit. But look at this. A massive 23% of credit still comes from local moneylenders, and another 7% from relatives and friends. There is a story in our textbook about a small farmer named Shamal who borrowed from an agricultural moneylender at an interest rate of 5% per month. Guys, that is 60% per annum. That kind of rate is just financially crippling.
Let's break down exactly why this divide matters so much. In the formal sector, banks and cooperatives are actively supervised by the Reserve Bank of India. The RBI ensures they maintain cash balances and lend to small cultivators and businesses, not just rich corporations. This ensures reasonable interest rates. However, as we discussed, they strictly require collateral. Meanwhile, in the informal sector, moneylenders, traders, and landlords, there is absolutely zero supervision. None. They can lend at whatever exorbitant interest rate they choose, like the 60% we saw with Shamal. And worse, there's no one to stop them from using unfair, coercive means to get their money back. Because the interest is so high, a huge chunk of the borrower's earnings goes straight into just paying the interest, leaving very little income for themselves.
Finally, let's head into Section 6, Credit in India today, and bring all of this data and conceptual understanding together.
There is a profound economic disparity happening in urban areas. Just look at this data. For the poorest households, a staggering 85% of their loans come from informal sources, the expensive, risky moneylenders. Now compare this with rich urban households, where 83% of their credit comes from formal sources like banks. It's a glaring inequality, right? The rich, who already have money and assets, are availing cheap credit, whereas the poor, who desperately need that financial help to develop and survive, are forced to pay massive, unfair amounts to informal sources simply because they lack collateral.
So let's check your understanding on this super vital concept. Why should credit at reasonable rates be available for all? Why can't we just let the informal market handle it and look the other way? The answer is that cheap and affordable credit is absolutely crucial for the country's overall development. When interest rates are reasonable, people can actually borrow money to invest in their future. They can grow better crops, start a small business, or set up a small-scale industry. High interest rates from informal lenders do the exact opposite. They drain the income of the borrower and push them straight into a debt trap, stifling economic growth and perpetuating the cycle of poverty. For a country to truly develop equitably, formal credit has to reach everyone. And remember, the landscape of money in India is shifting incredibly fast. We definitely have to talk about a major recent event, the November 2016 demonetization. The government declared 500 and 1,000 rupee notes invalid almost overnight, requiring citizens to exchange them for a new currency. While the primary goal here was to tackle corruption and illicit cash, it also acted as a massive catalyst for a digital shift. Since then, there's been a massive push away from relying strictly on cash. Today, digital transactions through internet banking, ATMs, debit cards, POS machines, and especially scanning QR codes through the UPI system are literally everywhere. This digitalization makes transactions smoother, creates digital records that can actually act as a form of documentation for loans, and brings way more people into the formal financial ecosystem.
So, I want to leave you with this final provocative thought. If we know for a fact that formal, cheap credit is essential for equitable economic development, how can we expand banking and cooperative societies to all areas so that everyone, and not just the rich, benefits? As you've seen in this explainer, money and credit are the absolute heartbeat of our economy. They dictate who gets to grow a business and who gets pushed into poverty. But until affordable, accessible, formal loans reach every single household and village, true economic equality will remain just a dream. Thank you so much for joining me on this deep dive. Keep asking great questions and keep learning.